Hi guys, this is Dr. Satpute from Stock Market Files. In earlier videos, we have understood what is a straddle and what is a strangle. In this video, we'll try to understand should we make a long straddle, long strangle, or short straddle or short strangle. Now, first, let's try to understand when we will go long, when we'll have long straddle or strangle, right? So when our view is volatile, that means when we have some intuition or some knowledge or some understanding from the news or from other sources that market may become volatile, right? That means it can move to either direction, right? And the move will be highly strong, very strong, right? So that time we will say that market may be highly volatile, right? So that time we will go for either long straddle or long strangle. So we'll go for long straddle or strangle only when our view is highly volatile. Right? Now, if our view is a range bound market, right? When we feel that there is nothing is going to happen in the market a lot, so that time the market may become range bound. So that time we may go for short straddle or short strangle, right? So now again the question is when we are going long, which should we go for straddle or strangle, right? So let's try to understand that. So long straddle. So when we'll go for long straddle. Now a long straddle is for the traders who are risk takers, right? Who want high return, and of course when you want high return there will be high risk, right? So this long straddle is a strategy in which we buy C and P of same strike, right? We buy C and P of same strike, and this strategy is high risk and high return, right? So this is the high risk and high return strategy. That means your risk is high, right? Your loss will be high, and of course your return will also be very high, right? So if you are a risk taker, if you are aggressive, go for long straddle, right? But if you are conservative trader, if you want less risk, right, you may go for long strangle. In the long strangle we buy put and call of different strike price, right? So this strategy is used by the traders who are conservative, who want to have less risk, right? So when the risk is less, of course, the return will also be less. Now, so that's why this strategy is for the option buyers who want to play safe, right? Or who want to take less risk. So they can go for this long strangle, right? And the aggressive high risk takers can go for the long straddle. Now, of course, both the straddle and strangle, we are going long here. That means we are buying. We are buyer here. Now, when we'll go for short straddle, again in short straddle, we sell P and C put and call options of same strike price. So this strategy, again, straddle is a strategy for risk takers, right? So this is a high risk, high return strategy. So short straddle is a high risk, high return strategy who are natural risk takers who like taking risk, high risk, and want, of course, expect high returns in turn. So they can go for this strategy, right? So then again, if you want to go short, I want to have a you have a range bound view and you want to go short, then you can go for, and you are a conservative sort of person or trader, you can go for this short straddle, short strangle, right? So in short strangle we sell put and call option of different strikes, right? So this strategy is for low risk and low return, right? This is a low risk and low return strategy. So those who want to take less risk, they can go for this short strangle, right? Okay, so the bottom line is straddle straddle is high risk and high return. Whether you are going long or going short, so this is high risk and high return. And strangle is low risk and of course low return, right? So depending on what kind of trader you are, you can go for straddle or strangle. So thank you guys for watching. Please stay tuned.